Okay, good afternoon, everybody, or good morning. Welcome to the AXA earnings presentation for the first half of 2013. Today we'll have a presentation, and this will be led by Henri de Castres, our group's chairman and CEO, Denis Duverne, our deputy CEO, and Gérald Darlin, our group CFO. As usual, the presentation will be followed by Q&A. And with this, Henri, I hand over to you.
Thank you, Mathieu. Good afternoon, ladies and gentlemen. I'll go quickly with Denis and Gérald through the presentation to leave as much room as possible for questions. So, first half of 2013, I think the performance is a strong one with a combination of sound growth and improving margins. This is reflected in underlying earnings. They are up 16%, 11% on a per-share basis, which puts us at the top of the range when compared to our Ambition AXA ambition. Adjusted earnings are even up more because they are up 26%. This is including the capital gains we've made on the disposal of some of the BNP shares, where our remaining stake is now 2.9%. So I think this is positioning us well. We intend to keep the amount of realized capital gains on a recurring basis within this range of 300 to 500 million. And the payout ratio, as you know, is 40 to 50%. We have no intention to change it. Underlying earnings, if you look back since we have started Ambition AXA, have grown at an average of 6%. The performance of this half is helping lift it a little bit. If you look at the return on equity, 16.5%, there is some seasonality in it, but what we want to show there is that we are comfortably in line with the 2015 ambition, where we've set a goal of 13 to 15%. We are even for this half slightly above that. The operating cash flows, we are in line there too with the trajectory, and the debt gearing is at 26%, largely unchanged, and there too well on track. More interesting maybe for you, what's the business mix? We know that our intention has been to have the general account decline in proportion and to increase the amount of unit-linked products, because this is in the best interest of the clients, but also in the best interest of the shareholders because of the margins. If you look at what has happened this semester, it's very much in line with the previous evolution. Unit-linked is continuing to go up, has now moved from a little more than 30% in 2010 to more than 40% now. General account has been reduced by approximately 50% over the last 3 years. This in an environment where margins are continuing to improve, and particularly noticeable is the fact that the general account business is profitable again. It was already profitable, I would say marginally 5% last year. It's now 10%. So overall, the NBV margin is at 33%, which we think is a good and solid performance. The property casualty business, growth rate over the middle term, 4%. We are achieving this semester a good combined ratio below 96, 95.7. And this despite some natural catastrophes and despite the fact that, as we had told you in the past, the amount of bonis extracted from previous years has a tendency to get slightly smaller. So solid performance in P&C. Denis will come back to that into more details. Capital management has remained active, and we have undertaken during this semester a couple of transactions which are very symbolic from that standpoint. We've sold the Moni portfolio for approximately 800 million euros. We also have initiated the disposal of the management company of AXA Private Equity. So disposal in major businesses or major countries to free up capital for acquisitions in the emerging. And we are particularly pleased with the transaction we've made in China, acquiring 50% of Tianping, the P&C Chinese player, with the intention to develop it as a direct player in the Chinese market. Chinese people are buying 17 million cars a year, whereas in the US only 13 million are sold. Many of these cars need insurance. The number of cars sold is going to increase. So it's really a very, very attractive market for P&C players going forward. And the ambition we have with our partner, as this partner has been saying, is to build the Geico of China. The efforts to reposition the group towards high growth markets are continuing. There too, if you take a middle-term perspective, since 2010, the growth rate in APEs has been 22% for the life business. It's continuing this semester. The life operations in the fast-growing countries are contributing to 16% of the group total APEs. And in P&C, the growth rate has been 17%. It's now contributing to 14% of the group revenues. So you see that the target to get to 20% is perfectly reachable with businesses which are sound and producing very decent margins. In the semester, we've seen further growth from our ICBC venture in China, as an example, 39 million for our share in APEs. We see that as a good evolution. Efficiency, we are well on track with our efforts, both on the savings side and on the investments to prepare the future. I don't think I need to insist on that. We had initially a 1.5 billion savings target. We have brought that up to 1.7. I think it's fine. Solvency level, comfortable. It's at 204%. This does not take into account the positive impact of the transactions which have been undertaken during the first half. They would have lifted this ratio by a couple of points, a little more even. We think we are very comfortable at these levels. This is not an issue at all. We've put as an indication the Solvency I number, even if we think that now Solvency I is irrelevant. The businesses which have been challenging over the recent years are gradually recovering. If you look at the general account savings business, as I told you, our intention is to progressively reduce the proportion of this business in the total mix. So the net flows are negative. The margins are going up, moving up from 4 to 10%. So this is good. Unit link is growing significantly for the semester. The proportion of unit-linked products in the new sales in France is now around 30%. At the bottom of the market, it had gone down to 11-12%. So this shows you that the risk appetite of the clients in some of the key markets is gradually coming back. In the US, the VA portfolio has been behaving well this semester. And I would mention also that the decision we took in terms of hedging at the end of last year has proved to be particularly appropriate. VAs have been producing decent underlying earnings. Last but not least, asset management. Flows are now, for the second half year, back into a positive territory with 12 billion of net new inflows, coming mostly from AXA Investment Managers, but coming also to a lesser extent from AllianceBernstein, which is gradually recovering. So what's our intention now? Continuing the efforts, especially given the fact that Denis and myself, we intend to continue to work for at least an additional 4 years. Our first priority is to deliver Ambition AXA, but we have to prepare for the future and beyond Ambition AXA, because a very strong feeling we have is that technologies are going to transform the business faster than what many people anticipate. The combination of big data and digital is transforming both the understanding of the risks and the underwriting and the distribution and the customer intimacy of these companies and these businesses. So rather than seeing it as a threat, we see it as a great opportunity to try to stay ahead of the competition, and we are working hard at understanding what's going on and trying to benefit from it. So that's what I wanted to share with you before leaving the floor to Denis and Gérald. Thank you.
Thank you, Henri. Good afternoon, everyone. So we are going to talk with Gérald about the details of the financial performance. I will start with the group earnings, a solid 16% growth, as you've seen, a growth in life, P&C, and asset management, which I will comment further. International insurance, a slight decline coming from a combination of lower investment income and higher taxes at AXA Corporate Solutions for a large part. You see also that banking had a solid first half. Holdings are pretty much in line with the previous years. Looking at the underlying earnings development, you see that we have strong contribution from life, P&C, and asset management. You see a negative 46 million on Forex, which is largely explained by the translation of our Japanese earnings into euros. There was a very strong decline of the yen. The performance of our Japanese entity is very good and has largely offset that decline, but the Forex had a negative impact on our earnings overall. Adjusted earnings, very strong performance at plus 26. Henri mentioned the BNP Paribas sale. Otherwise, we had approximately the same level of impairments as last year, but slightly higher capital gains, even excluding the BNP Paribas disposal. Net income is what matters most for the press. I know that you are not significantly more sophisticated. So the main impacts on net income are related to the mark-to-market of some elements of our P&L. Most of our derivatives are benefiting from hedge accounting, but some don't, mostly in the US. So we had derivatives that were not eligible for hedge accounting. That's the biggest negative. The second one is the mark-to-market of the non-consolidated funds that are in AFS P&L, so available for sale through the P&L instead of AFS through OCI. Exceptional operations, is impacted by the disposal of money. Even though the disposal will only take place in the second half, we take the negative impact now according to the accounting principles. Restructuring costs, we have restructuring costs as we reduce our expenses year on year. This year we have a more important impact coming from the write-down of leasehold improvements in the US, both at AXA Equitable and AllianceBernstein, where we have reduced staff considerably and we are vacating space. And as we rent those sublease those spaces, we have to take some write-downs. On the life side now, first talking about new business. New business was up 8% in mature markets and 15% in high growth markets, a total of plus 9. Asia continues to perform extremely well with a growth of 24%, Asia excluding Japan. This is partly offset by CEE, which is down 29% as a consequence of the continuation of negative reforms on the pension side. After Hungary, we saw Poland. In Poland, they are now talking about a quasi-nationalization of the second pillar of pension funds. So maybe more bad news to follow, but clearly we've been disappointed by the CE. New business margins have increased by 4 points, and this is an increase pretty much across the board, both in mature markets and in high growth markets, coming from what Henri mentioned earlier, the improvement of our business mix, which you can see in more detail here with a growth of protection of 9%, quite strong in Switzerland on group pension, quite strong in Asia and Japan, and also good growth in France, and a margin of 54%. Unit-linked is also progressing nicely at plus 21% with a 27% NBV margin. The growth here is quite strong in the UK and in the US, as well as in the Medellin region. GA savings, on the contrary, is down 17%, in line with what we had mentioned before. NBV margin is improving, however. We were at 5% last year and we were negative 2 years ago. So our margin on GA savings, thanks to repricing and redesigning of the products, has improved. Mutual fund sales grow 19%. This is coming from the UK and the US. The NBV margin is not significant, as you know, because this business doesn't use any capital. And when you look at the net flows, you can see that we have tripled our net flows compared to a year earlier, 3.9 billion net flows against 1.3 billion in the first half of last year. And again, the performance is in line with the allocation is in line with what we have announced. So positive flows in protection and unit-linked, negative flows in savings, in GA savings. Looking now at the earnings picture on the life side, you see that the earnings are growing by 15%, and the growth is explained by the growth in savings and, more importantly, in unit-linked. But on the protection side, we see a slight decline of earnings coming from less favorable claims development in France, Japan, and the US. On unit-linked, you see that we are doubling our pre-tax earnings thanks to higher fees and revenues because of the equity market performance, but also much better performance of our VA portfolio in the US. Moving now to P&C, revenues are up 2%. They are up 1% in personal lines in spite of a price increase on average of 3%. The portfolio is growing in direct and high growth. We see a decline of volumes in mature markets, more particularly in Belgium and Germany, where we increase prices, and I will show that a little bit later, more than the competition. Commercial lines is compensating that with a growth of 4%, average price increase of 3.3%, but the portfolio growth not only in high growth markets, but also in markets like the UK and France. Looking at the price situation, on the left part of the slide, you see the price increases that we have implemented on our portfolio, 3% on personal lines, 3.3% in commercial, and you can see some very high numbers like 7.9% in Germany in personal lines, 5.3% in Belgium. We have deliberately accepted to lose some portfolio to radically improve the positioning of the portfolio in those two markets where prices were positively oriented in the market, and we thought it was the right time to accelerate the price increases. On commercial lines, the situation is also quite impressive in France with price increases of 5.4% and an average of 3.3%. Looking at the market pricing trends on the right side of the slide, here you don't have any insight into our own intention. You have an insight into what we expect the markets to do. We see a continuation of price increases in France and Germany. We see prices leveling out and sometimes coming down in the UK, Switzerland, Belgium, and Southern Europe. In Switzerland, it's not a worry because our combined ratio is around 90%. It's obviously slightly more worrying in Southern Europe, where there is, because of the recession, some price competition. P&C overall different by markets. Mature, so you see mature markets overall 0, high growth market a growth of 15%, direct a growth of 7%. And in terms of combined ratio, an improvement across the board with our direct portfolio, which is not yet mature, now getting to 99.9% of current year combined ratio, which is quite an achievement given the level of growth. and overall a current year combined ratio improving by 0.9 point to 97.5%. Earnings on the P&C are growing by 10%. This is because of the combination of this good current year combined ratio evolution, in spite of slightly higher weather events, 0.7% of natural catastrophes, of which 73 million of impact of the German floods. Slightly lower positive prior developments at minus 1.8% to an all-year combined ratio of 95.7, slightly better than our medium-term target of 96. Investment income was almost stable, with asset yield stable at 3.9%. On the asset management side, we had the second semester in a row of positive flows, both at AXA IM and AllianceBernstein. AXA IM had a very nice first half with 10 billion euros of positive flows. AllianceBernstein had a very good first quarter, more subdued second quarter with positive flows of only $200 million. With the announcement of the tapering off of QE2, what happened was a liquidity squeeze in Asia, in emerging markets, which led to outflows in retail in Asia for AllianceBernstein. And in spite of a very strong institutional performance, these negative flows in retail led to close to zero net flows, I mean positive, but close to zero net flows in the second quarter. Underlying earnings for asset management went up by 24% as a consequence of a positive leverage coming from a growth of expenses of 7% against the growth of revenues of 12%. I'd like to hand over now to Gérald. Thank you very much for your attention.
Thank you, Denis. So, shareholders' equity is going down from 53.6 to 51.5. Let me highlight two drivers of change, starting with a decrease in net unrealized capital gains, explained by the rise of interest rates. On the euro, rates went up between 30 and 40 basis points, and on the T-bond, 10 years T-bond went up by 70 basis points. That explains the minus 2.5. The forex movement, net of hedging instruments, is linked to the investment in non-euro subsidiaries, I mean Japan, the UK, and Switzerland. Economic solvency, as explained by Henri, pretty stable, and we are at 204, including the net proceed from money, which should arrive in a third quarter or fourth quarter. We should be at 208. You can see on the right-hand side that it's the highest sensitivity is coming from the interest rates. On the debt gearing is the debt level is quite stable at 12.9, and we have two new issuances in January for 1.6 billion euro, which are offset by 0.9 senior debt reimbursement and 0.5 sub-debt early redemptions. That explains that the total debt is pretty stable. Debt gearing is at 26. We should be at 25, including the proceed from the closed money portfolio disposal. And interest coverage moves up from 9.3 to 11.6 times, mostly explained by the high level of adjusted earnings. A few slides now on ALM, on asset liability management, starting first with the asset yield, which is stable for life at 3.8, for P&C at 3.9. And on the left-hand side, you can see the asset allocation, which didn't move a lot. Mostly it's fixed income in govies and corporate bonds. And you can notice that our listed equities went up from 3 to 4%. Duration pretty stable, and we are managing a duration gap close to 1 year. Next is the investment, the current investment policy in the in the first semester. We have been investing 29 billion on the bottom left, 29 billion euros at an average rate of 2.9%. And you can see that we have been investing 41% in govies, of which 4 billion on European peripheral countries, mostly Spain and Italy, 31% in corporate bonds, and I would say the rest in more diversified, high quality, and less liquid assets. Life investment spreads. Starting with the investment margin, the investment margin went up from 72 basis points on a yearly basis to 77, within the guidance of 70 to 80 basis points. You remember maybe that for 2012 we were at 78 basis points. On the left-hand side, you can notice that the in-force business, we have a significant spread over guaranteed rates for in-force at 160 basis points. And for new business, it's much higher, 240 basis points. It should be noted that the general account savings business is sold mainly to attract unit-linked business. Last, this is a sensitivity. We try to highlight what the sensitivity of the rise of 100 basis points on interest rates, starting first with underlying earnings. So it's positive for underlying earnings because it means investing at high yields. It's negative for net income, as explained before by Denis, because we have some hedges, economic hedges, which are not eligible for hedge accounting. Embedded value, it's positive. These figures are the sensitivity of the 2012 and 2012 EV, plus 5% for plus 100 basis points in interest rates. For the US, it's even much higher, plus 23%. And taking volatility plus market evolution, sensitivity should be twice this level. Economic solvency is up, so it's directly linked to the interest rates. I hand over to Henri now for the conclusion.
Thank you, Gerald. Well, my conclusion is going to be brief because I'm not going to repeat what has already been said. I think it's a strong quarter, showing progress on all the key fronts. We look at the future with a mixture of caution and confidence. Confidence in our own acts, caution as far as the world and in particular Europe is concerned. But we think we are well aligned with our long-term goals. So thank you very much. And now, let the floor ask questions. Who is going to raise the first one? Is there a volunteer? Go ahead. If you could just say who you are, because for the people who are listening to the conference, it's always good to know who is speaking.
Thank you very much. It's Farouk Hani from Citi. 2 questions. When you showed that chart of disposal of mature businesses and reinvestment into high growth, there's a 3.5 billion gap. What have you done and what will you do with that money? That's question 1. And question 2, that mortality profit dip, it's quite significant. When you look back historically, it's quite a big drop. Will that recover in the second half? Can you explain a little bit more about it? Thank you.
Sure. Denis, you want to take the first one and Gerald the second one, or the reverse order as you like?
No. The reduction. The difference between the 8 and the 8.5 and the 5 billion is what we did in terms of deleveraging. Basically, we strengthened the balance sheet and deleveraged, and that's what has happened during that period.
But obviously, the stuff that you've done recently, are you basically saying that you're just going to build up a liquidity buffer?
The stock that
will the two not balance at some point?
Well, the stuff that we have done recently, and you must have noticed one element which was new in the disclosure this time. We disposed of announced the disposal of money, which is 800 million euros. We announced the disposal of AXA private equity, which is 510, but 350 in the first place, plus minus our investment, let's say 300 million. So that's 1.1. And we said that we were investing 500 million in Tianping. We added 300 million of future investments to fund the growth of the business. So the gap between the two is not a big amount. It's only 300 million of difference between the two. So I mean, we are not building a treasure chest at this point. We believe that we should continue to strengthen the balance sheet by retaining a significant part of our earnings and continuing to keep our payouts between 40 and 50% of adjusted earnings. And that, we believe, is prudent in the current circumstances, given the uncertainties on financial markets, the uncertainties on Solvency II, the uncertainties on higher loss absorbency related to our SIFI designation. All of that means that we do not plan to change our payout policy so far.
Gerald, do you want to take the question on the mortality
yes.
in the US?
Maybe you can, Farouk, you can go to page P19 on the appendix, and in fact, it's we had some positive one-offs in the past on mortality and morbidity, and we didn't benefit from this year. Another way to explain it is the fact that we had a combined ratio on protection and health which was at 94%, and this semester it was at 95%. So on the technical side, I cannot tell you exactly what will be the future, but anyway, with the growth of the top line, we should still keep improving our combined ratio.
But to your question of whether this is a one-off or a permanent trend, we see that more as a one-off than a permanent trend.
So those actions you specified were dealing with particular problems in that quarter. Okay,
yeah.
Thanks.
Yep.
Oliver Steele at Deutsche Bank. You talk about having increased your equity weighting and also the weighting in corporate bonds. I'm just wondering, where have you done that, and what does it do to your reinvestment rates going forwards?
Oh, it's been done in different countries. It's spread over the most of the countries, except in the US, because as you know, we don't own equities in the US. So yes, and it's mostly, I would say, it's mostly on the shareholders' fund. So it's an investment, roughly speaking. It's been an investment of roughly 3 billion in the first half.
Thank you. Nick Holmes at SocGen. A couple of questions. First one on the US. GMIB reserves, to be specific on those, now seem to be significantly in excess of your net amount at risk, over 200%. And I wondered whether there might be any scope at some future date to return some of those reserves which have somewhat depleted earnings in the past, but not very seriously. I know a lot of them are hedge gains, but that's my first question. Second question is on Asia. Obviously, you've made some big investments in China, and I wondered if you could share with us what your thinking and aspirations are going forward. I mean, do you see potential for more joint ventures in that region? I mean, Southeast Asia as well. And what is your ambition?
I'll start by answering the China question and leave time to Gérald and Denis then on the US. In China, we now have, in China mainland, we now have 2 ventures. The first one is with ICBC. The second one is with Tianping. The first one is in life. We have 27.5% with the possibility to go up to 30% over time of the venture, but we have the management. On the Tianping thing, it's just fresh and in the process of approval by the CRC. It's a 50-50% venture. The 2 partners are of a very different nature. ICBC was, until very recently, the largest bank in the world and is still the largest bank in China. State-owned, very powerful, state-owned company culture in China. Tianping, the shareholder is a Chinese, I would say, businessman of the new generation, has started selling bags on street corners, has moved from bags to shares, has made millions, zillions. Very, very entrepreneur-minded, extremely flexible, has assembled a very, technically very good management team. Very different cultures. We have to learn to live with these different cultures. Point one, we have to make these two joint ventures successful. And I think I don't see us necessarily, I don't think we need anything else. Within 2 quarters in China on the life side, we've moved from being one of the many foreign insurers to being the largest one by far. If you rank the Chinese, if you rank us among the Chinese companies, we are now probably number 10 on the life side, number 10 or 11 and growing. So the idea of the venture is to benefit from the distribution strengths of ICBC. And we think it's going to work, and I will remind you that the venture is supposed to become profitable end of 2015, something like that, which means particularly fast if you look at the economics of any life operation anywhere. The only place where a venture has become profitable that fast is Indonesia, in the venture with Mandiri, which has been for us a huge success. On the P&C side, the game is exactly what I described you in my presentation. The Chinese automobile market is the fastest growing one in the world and will become the largest one. It's underinsured. They have no significant direct player. Tianping is today a small company. It's between number 10 and number 20 in the market, but is profitable and has a lot of room for expansion because they have they have a license to operate direct on the whole territory, which is a very big, I would say, competitive advantage, at least for a while. So making these two ventures a success over the next 3-5 years is the priority number one. Could we do other things in Asia? As you've seen, we have announced yesterday the fact that we now have an agreement with the Singapore Post Office, where we are dislodging one of our beloved competitors. It shows that we have the ability to grow through bancassurance or similar channels in Asia. If you look at our presence in Asia, we are now the largest international P&C player in Asia. We are not the largest one by far on the life side, but in P&C we are the largest one. We are developing these ventures with banks. If we can do additional deals to strengthen our distribution there, we would love to do them. We are looking at India, where we hope that the government is going to lift the 26% hurdle on foreign investment, because this would open for us the possibility to increase our stake there. So I would say in Asia, in China, I think we have what we need. It's up to us and our partners to learn to live together and transform that into significant successes. In the other places, it's going to be more expansion through the, I would say, acquisition modes we have developed over the last 5 years. US VAs, Gerald, your favorite subject?
Yes. Your question, Nick, is, if I well understood it, is how do you explain that the net amount at risk decreased quite significantly, that we are at 4 billion and that your IFRS reserve didn't decrease, and we still are at twice the amount, i.e. almost 9 billion versus 4 billion. I would explain it this way. That means that the 4 billion correspond roughly to the intrinsic value. And keep in mind that most of our reserves are mark to market. And they are on a market consistent basis. So that means that you have the intrinsic value, but you have the time value of money. That's mostly it. And that's why your following question was, could we expect to have a decrease of these reserves? The answer is yes, but over time. It's not something immediate.
And it can take 40 years, just to give you a sense of timing.
But we'll still be there.
Sorry to follow up just very, very briefly. But 40 years is a long time. If markets were very, very good, would you possibly consider releasing something?
Now, if the market would be very, very good in such a case, that means that the policyholder behavior could change, and in such a case, but after a while of good and positive experience, we could imagine to review our reserves, and we could review the way we compute the reserve in order to calculate the policyholder behavior. This is possible, but you can understand that we are cautious, and it's not after 6 months or a few months improvements that we can say, okay, we can release some reserves.
That's great. Thank you very much.
Thank you, Nick. Next question.
Ralph Hepken from KBW. Two things. One is on systemically important financial institutions. You are on the list. Perhaps you can share with us your thoughts of why you are on the list. What were the driving, basically, reasons for you to be included? And second, of course, any possible impact on your economic capital requirement, how you would handle these. And the second one is just a numbers question, which is relating to realized gains. If you look at the gains harvesting and you exclude the gains generated from the partial sale of BNP, it sort of looks as if you're already in the middle of your targeted guidance range, but that is a guidance range for the full year. So it would be interesting to see how you think about gains harvesting in the second half. Thank you.
On the systemic risk thing, we see it as a distinction. It's not being Knight of the Garter, but it's close to it. I was saying to some of you, in France we have a say for that. We say when you have a very prestigious circle, you have to badmouth it, but try to be part of it. So I think the reason for which we are there is the regulators and the supervisors wanted to capture the large institutions. I mean, this whatever has been said about the criteria, I think size has played, and I would say the diversity of our geographical exposure has also played. I mean, there has been no surprise on who is in the list so far. So for us, it's not a surprise. I don't see that as a threat. On the contrary, what we have to watch closely is two things. The first one is we are very much in favor of transparency and disclosure. We hate bureaucracy. And we hope that the needle is going to be well positioned. Because if this ends up by sending additional thousands of pages to the supervisors who are never going to be read or never going to be helpful to really understand what's driving these companies, I think it's going to be a waste of time and money. The second point is a point about HLA, loss absorbency. They will have to define an approach, but I would remind you that the situation of insurers is very different from the situation of banks. In banks, they have a common standard, which is Basel III, which doesn't exist in insurance. The US and Asian companies, as an example, are not measured in terms of solvency the same way as European ones. So this has to be mitigated by the relative, I would say, tightness of the requirements, Solvency II versus the rest of the world. And given the fact that Solvency II is probably the most demanding system on Earth, we look at what's going to come out from this debate closely, but I wouldn't say in a pretty relaxed way, but we think that this will have to be taken into account. And I think that some of our competitors who are on the same list as us have made statements exactly in the same direction this morning or yesterday.
Second part, realization of
gains, yeah.
So as you know, our guidance is 300 to 500 million euros of capital gains for the year, and I mean on average, we expect to remain within that range.
Even though you have already basically generated 400 million.
Yes.
Yep, Mr. Crean.
Andrew Green, Autonomous. 3 questions. If I might. You've given guidance on your spread margins in the life business as 70 to 80 basis points during a period of falling interest rates. As interest rates rise, is there a pressure on that spread margin as you have to push up crediting rates with interest rates? And how do you see that? Secondly, your cost-income ratio in the asset management divisions is crudely 78%, which is high and obviously a residue of problems you've had. Could you give us some idea as to where you aim to get that cost-income ratio down to and over what period? And then thirdly, economic capital, there was no visible effect in the coverage ratio from the rise in interest rates. If you did not do US on equivalence, which is where interest rates rose more, how much would your economic capital have improved?
Okay. Yes. Your first question, Andrew, is on the investment margin between 70 and 80 basis points. For the time being, you know, I don't expect. I said last year that we could expect to be at 75 around, and I don't expect that any increase of the interest rates will have an impact. Why? Because as you can imagine, in a lot of countries, we don't have any. We are not locked by guaranteed interest rates. It would be the case in case rates would go much higher. That means that we can expect to keep this type of margin up to a certain level. If rates would move up by 150 to 200 basis points, in such a case, we might be under pressure. And in order to avoid this, in the countries where we could consider that our margin are under threat, there we are we are benefiting from the present market in order to buy options in order to protect our margin. On the economic capital, that was your third question. Economic capital, excluding the US equivalent, would be roughly at 170%. No,
Slightly improved.
Slightly improved. We were around that 160 last year.
On the asset management cost-income ratio, clearly this cost-income ratio was under pressure in a period where assets were going out, and the challenge was to bring the cost down at the pace at which the revenues were coming down. We did that, but we effectively saw our margin slightly decline, and this is because we have kept our distribution footprint largely intact. I believe it was important to do that because as performance improves, we do have the distribution capacity to have net inflows, and we are seeing that. We've seen that now in the last 2 semesters. You see the positive leverage that we showed in the first half with a positive gap of 5 points between the expense growth and the revenue growth. We have this operational leverage favoring us now, and I expect that we could get to at least 30% of a margin of 30% or a cost-income ratio at 70% or lower in the medium term. But that depends on the continuation of the positive flows. But we do not expect to further decrease our distribution footprint when we have all expertise or most expertise going right in terms of investment performance. We expect the positive leverage to gradually bring down our cost-to-income ratio.
Next question, Blair.
Thank you very much. Blair Stewart from BofA Merrill. The first one is just a clarification from the earlier question on the technical result. I think you said initially, unless I heard wrongly, that the experience previously had been exceptionally good and that this year was more normalising towards a standard run rate, or did I pick that up wrongly?
No, what I said is that we had some positive experience in the past. I'm not saying that we won't get any positive experience in the future. And we can expect that everything equal, we had a relatively negative experience in the first semester.
So basically, the reason Gerald phrased it this way is that we usually have positive surprise mortality gains, basically, and so we were surprised this first half not to have positive mortality gains as much as we used to have.
It's clear, thank you. The second question is just on the investment yield. It's stable in P&C in particular. I think you previously guided towards maybe a 10 to 15% drop per annum. Just wondered if that's changing. And thirdly, be interested in your comments around Poland. If the second pillar is nationalised, what would be the impact on your business?
On investment yield. On investment yield, yes, indeed. I told you that we could have a 10 basis points decline. In fact, what we have been doing is that we have been investing 29 billion, as I presented, at a relatively high rate. Why? Because we were quite successful in diversifying and we decided not to invest in traditional govies or in low-yielding corporate spreads without taking an additional risk. First, we decided to invest 4 billion in sovereigns, and it's proven to be the right choice. Second, just to give you an example, when we are investing in loans which are equivalent of single A loans, we can get 100 basis points if you buy a bond, and you get 200 basis points if it is a loan, but illiquid. That's mostly it.
So it's right to say, Blair, that we did expect to have maybe a slightly lower yield on our new business, on our new investments this year, and we plan not to have a lower yield, in fact, than what we had last year.
So these gentlemen are very modest. The reality is that they have managed the investments very well.
On Poland?
On Poland, yeah. On Poland, what is at stake is 400 million of embedded value and a couple of tens of millions in terms of yearly earnings. So nothing major, but it's worrying us regarding Central and Eastern Europe because this happens after Hungary. I think these countries are shooting themselves in the foot. The reality is that they do that for a sort of, accounting trick. Poland has a constitutional limit on debt versus GDP at something which is, I think, 60%. They are getting close to this limit. And due to the interpretation of the Eurostat rules, they have the feeling that if they, quote, nationalize the second pillar, so take the bonds which are held by the pension funds and substitute themselves as a state to the obligation of the pension funds toward the pensioners, they will be able to eliminate in their consolidation the debt which is represented by the bonds without having to take into account the future obligation of the pensions. This is a Ponzi scheme, which is allowed at this stage seemingly by Eurostat rules for as long as what it will last. We didn't react that much in Hungary, but if this were to become true in Poland, we would become very aggressive from a legal standpoint in Brussels and elsewhere, because we think that this would be nationalization and that this would justify indemnification. We are not the biggest ones in this market. Players like ING and Aviva are much larger than we are, but our very firm intention is to, I would say, fight for our interests, the way we fight in rugby. Meaning not always successfully, but most of the time successfully.
Hello, Federico Salerno, MainFirst. Just on the US restructuring, how is it proceeding? What kind of costs should we expect for the second half relative to the 120 you had in the first half?
The US restructuring.
Yeah. Well, the US restructuring is essentially done. We have we have vacated a number of floors in our main Manhattan building. We have and the downsizing has essentially been done. So you should not expect significant additional restructuring expenses in the US. The right sizing has been completed over last year and the first half of this year.
William Eltigan, Goldman Sachs. A couple of questions. Firstly, you mentioned you thought Solvency I measures were irrelevant, which I can understand. What's your perception of which metrics the French regulator is looking at the moment?
Solvency II.
Thank you.
No, they are looking at both.
They are looking at both,
yeah.
but the reality is what matters for them now is Solvency II.
Second question was, you obviously benefited along with your peers with substantial improvements in claims frequency. What's your sense of how things can improve from here? And the final question was, in your presentation, you talked about substantial technological shifts, changing your business model. I was wondering, could you just give an example of the kind of things you have in mind?
Good.
Second question. Could you repeat the question on claims?
Yep, I think you, along with many of your peers, have benefited from substantially improved claims frequency. What is the scope for that improvement to continue?
Okay, well, in terms of claims frequency, as you know, it's to some extent tied to the economic environment. So to the extent that European growth has been pretty subdued, to say the least, that has a positive impact on claims frequency. I mean, if we are not in a downright recession, which could increase arson fires and those kinds of things, people drive less. There is not too much overwork and night shifts and so on. So claims frequency is better. And to the extent that the European economy doesn't rebound massively in the second half, and nobody believes that would happen, we should expect claims frequency to remain along the same lines. What can affect the claims situation for us could be the weather. As you saw, we had an amount of weather events that was higher than last year at 0.7 points of combined ratio, but probably lower than the long-term trend, which we put, given our portfolio mix, at 1%. So we cannot plan anything in terms of natural catastrophes. So you could imagine that natural catastrophes could be higher in the second half than they've been in the first half. Overall, claims frequency is, I would say, should not change much in the second half versus first half.
On the last part of your question, I think this is going to be absolutely fundamental for the business. If you look at what is the real, I would say, essence of the insurance business, it's in fact accessing and understanding data to price risk and deal with policyholders. So the first thing which is happening is an incredible amount of data is now available in a way which was not existent years ago and can be manipulated, can be handled in a way such that it gives a better understanding of the risks. This is going to enable, for those who are going to understand the way to access this data, this is going to enable a much more accurate pricing if you can manage to do that. Usually insurance companies were owning a lot of data, but it happens that there is now available in the cloud, much more than what used to be available, much more easily. So one of the questions, there are a number of questions surrounding that. Can you access it? Do you understand how to understand and use it? Could other players, not necessarily coming from the insurance industry, do that and use it as a competitive advantage? Google. So that's question number one. With a very, very, very big, quote, legal question, which is going to affect this and the next point, which is what's the limit between customer intimacy and respecting privacy, which I think is going to be the big legal debate for the next, I would say, generation. I think the debate on privacy surrounding internet is going to grow the way the concerns on climate change have grown over the last 10 to 15 years. This is a big, big, big legal question, and industries who are living out of using data on individuals have to ask themselves the question, do they know what the rules are going to be or how they are going to change? So this is the first very fundamental shift on which I think we need to have a view. The second point is relationship with the customer. We have the direct business, we have traditional networks. The direct business is growing fast because it's a business where most of the transactions are done through internet. Our traditional networks are very solid, very resilient. They have a high degree of, quote, traditional customer intimacy. What the the game is not a win-lose game. It can be a win-win game. If we can convince our sales force, traditional sales forces, to move to multi-access and to digitalize themselves quickly, they will become multi-access and keep a competitive advantage when compared to direct players who are more siloed. Because I think what the customer is willing to have is multi-access providers. So there, what we need to do is to use all the technological revolution, of course, to develop the new channels like direct, but also to transform the traditional ones. On one hand, it's a big task because they start by being defensive. On the other hand, it has already happened in the past, at least twice. I mean, when they moved from, I would say, writing to using the phone, and when they moved from using the phone to using computers. So you just have to convince the old generation to change, and you have to recruit new guys who are natives in these technologies. That's it. Does it answer your question?
John Hocking, Morgan Stanley. Do you think there'll be a deal on Solvency II this year? And if so, where do you think it's going to end up?
Okay. Well, it's difficult to say. I'm sure that Christmas will still be on the 25th of December. I'm less sure that Solvency II... No, I mean, in principle, I mean, we hope that there will be a deal. Because if there is no deal this year, the risk is... I would say a postponement because of the new European elections, the new parliament, the new commission, and so on and so forth. So I think the sensible players in the industry are pushing for a compromise. It has to be a compromise. A deal on the current basis of the proposal from the EIOPA is not going to happen. So there has to be a compromise. The trilogue is going to start again in September, early September. We hope that progress will be made because for the large cross-border players, the alternative is not a very pleasant one. I mean, if you are a local mutual, you can say, well, I don't care. I'm going to deal with one regulator and we will find arrangements. If you are cross-border, the alternative of having 28 different regimes is not a very pleasant thing. So what we hope is that a compromise is going to be found. If you ask the same question to the very vast majority of the large European players, I guess, I mean, they would give the same answer because the industry is pretty well aligned on that. Yep.
Farouk Hani from Citi. You don't give cash flow data, and you've been clear about that, but I was just thinking more qualitatively. Are you finding that if you wanted to take capital out now, let's say from the US, from European countries, from Asian businesses, that you could, because your local statutory or rating agency solvency or economic is strong enough? Are you finding it, you know, basically if you wanted to have more central liquidity, that you could do that? I can understand why you would not if you want to grow in Asia and you want to avoid washing money around and incurring tax penalties and frictional costs, but are you finding now that you basically have more control and less subsidiarization? Thank you.
I would say qualitatively that the guidance that we have given, that we expected a remittance ratio of the order of 75%, remains valid. We do not have any indications that this remittance ratio would have to significantly go down or could significantly go up. We are pretty much in the same position.
Yeah, I mean, and I'm sure we're all modeling that, but what I mean is that by choice or by force?
I would say that corresponds to the economic situation of our various operating subsidiaries.
Thank you.
And if I may add one point, as you know, for the time being, we are subject to the local statutory rules. And in Europe, that means that we cannot expect it to change. So we will see later on at the time Solvency II will be in force. Then Solvency II will apply to the local on a solo basis, and this will be different. At that time, I believe we might have more flexibility in order to improve the global scheme. But it's far too early to give you any kind of indication, and for the time being, we can consider that more or less we are optimizing.
Mr. Stewart.
Thank you. Just on the US business again. I know it's far too early to start thinking about changes of assumptions on reserving, but just interested, have you observed any changes in customer behaviour over the last couple of months into better markets and higher interest rates? And secondly, how has the dialogue between yourselves and the New York State regulator evolved over the last 6 months, given some of the comments they've been making publicly about reserving and offshoring of reserves and everything else related to that?
I mean, I will try to respond to your second comment. There were a number of comments meant in relation to the redomestication by some of our U.S. competitors of their Bermuda operations back to I would say the mainland U.S. This is a move that we had anticipated ourselves last year when we moved from Bermuda to Arizona. So I don't see that we are under any specific pressure, given that all our operations are in the U.S. continent, subject to U.S. taxation and so on and so forth. So we have seen no particular change of behavior of the New York regulator vis-à-vis AXA in the recent past.
As far as your first question is concerned, the customer behavior, we can say that we are in line with our expectations. That means that it's not worse at all. And what we have been doing last year is we are in line. Of course, and that's what I said before, we should need much more time and experience in order to change it. But we can consider that we are on a safe side.
Any other question? On the phone?
We have a question from François Bossin from Exane BNP Paribas. Please go ahead, sir.
Yes, good afternoon, everybody. A few questions, please. The first one is on your cash position in the holding. How should we look at this? I mean, any minimum buffer you want to maintain there, and what would be the amount available for M&A or cash distribution to shareholders? That's the first question. The second question is on the NBV margin. I mean, it's been improving consistently over the past quarters. What kind of level are you targeting, and can we expect more, namely with higher interest rates? Thirdly, on banking, you had a good semester. I mean, is this something we should extrapolate, or what drove basically the good performance in this semester? And finally, what are your intentions with regards to your remaining 2.9% stake in BNP, and is it hedged against downside risk? Thank you.
We are not going to comment on your last question, and I leave the two other ones to Gérald.
Yes, about the cash position, nothing to do. We should not make any confusion between shareholders' fund and funds which are managed in front of the reserves. And the cash position that is here, it's a cash position for liquidity. Of course, it's part, this cash, when I tell you that the average duration is 7 years, a bit more than 7 years, this cash is including in it. So if we decide for whatever reason to have a kind of bubble situation, this is part of it. So it has nothing to do with a kind of buffer that will be put aside for investment. Your second question was about NBV margin. NBV margin is higher than expected, but you can notice that higher than initially expected, but this is due to our business mix. We have no intention to change our business mix. This improvement in our business mix in favor of more protection and health and more unit-linked business won't change. What's the sensitivity to a higher interest rate? As you know, it's positive, so the NBV margin is directly linked to the interest rates. On your third question about the banking, on banking, we have an improvement indeed, and you can see in the activity reports that last year we had a one-off in the French bank due to an advertising campaign, and which is not the case this year. At the same time, in Belgium, we had we realized more capital gains than we did in the past. So we can consider that the results that we posted in the first half is more in line what we could expect. It's more what we did last year, which was not really in line.
Do we have other questions on the phone? One.
The next question from Atanasio Pantores from Kepler Cheuvreux. Please go ahead, sir.
Yes, good afternoon, everybody. I have just two questions left. One is if you can provide us the impact of the fair acquisition cost in your life business profit and loss in underlying earnings, specifying if there is after or before taxes. And the second question, if you can give us some more color or free cash flow generation during the first half. Thank you.
We didn't understand your first question.
About the fair acquisition cost. You mentioned in the presentation that there was a less positive effect of the fair acquisition cost because there was an acceleration of the amortization in your US business. And if you can provide us what was the impact in the profit and loss, in the underlying earnings in life business of the fair acquisition cost.
Okay. Let's start with the DAC. You have a slide, an appendix on page 53 of the financial supplement. What I can tell you is that indeed we increased our DAC amortization. Last year we didn't in fact amortize. We increased our DAC, but we didn't amortize. Why? Because we had this huge one-off in the US coming from the policyholder behavior we just discussed before. In a few, just to be clear, this in the first half, roughly we have been amortizing a bit more than 300 million euros of DAC, and of which the US represents roughly 200. And that's the main difference. So your question about the impact on P&L, this cannot be analyzed in itself. It should be analyzed and compared with the situation of last year, where we had a huge one-off, which was more than 500 million euros, corresponding to this adjustment on the net to the adjustment in the US. What I can say is that the US contribution this year is higher than it was last year, and roughly speaking, we are a bit more than 100 million euros above where we was last year. The second question is about the free cash flows. As you know, we don't publish any free cash flow in the first half. Nevertheless, what I can tell you is that we are in line. That means that why? Because the free cash flow is mainly three components. The first one is life. and life is not very different. Slightly, we could expect that it would be in line with what we shared with you last year. And in P&C, the fact that we had an improved adjusted earnings in P&C means that our cash flow should be slightly improved. So pretty in line with what we have been discussing at the end of last year.
Last question. No question in the room. No question on the phone. If so, we are going to stop. Thank you.
Thank you.
And wish you a very good summer.